Hello, everyone, and welcome out to your Four Pillar Small Group Coaching. Today, we're going to talk about the Trader Workstation platform. We always start with a reminder that everything we go through is intended to be educational, instructive, so we're not suggesting that this platform is right for you. Every platform that you utilize will have similar tools and features. So the first thing you'd need to do is come over to the interactivebrokers.com website. From there, you can actually see that there's different things. If you haven't already opened an account, you'd click there. If I wanted to trade, I can actually download different platforms and utilize different platforms here. So as I go into the platforms, you'll notice that there's actually a few different things. There's a platform that you can download for your phone and utilize. There's a web-based platform. This is a little more simplistic. If you're brand new and you really want to just use a web-based platform, you can go right there and log in. You can use, again, on your mobile device, you can use Trader Workstation. This is what we're going to be analyzing. So if you haven't downloaded it on your desktop, you'd click there, you'd come in here, and you'd basically download the platform. Let's see, I got to scroll all the way to the bottom. And there it is. So there's the Trader Workstation, the latest platform for Windows, and we would download the platform. Now, once you've downloaded it, it will put a little icon on your desktop, and as you click that icon, it's on my other screen, let me click it there, it'll pull up the login page. So all I did was double click on the little icon on my desktop, and now I can log in, and there's a live platform or a paper trading platform. If you set up an account with them, you can set up a paper trading account. And from there, we can log into the paper platform. Once we've logged in, it will bring up a platform. Well, here's the demo account, the paper trading platform. And you'll notice a few things. When you first pull up the platform, it'll probably look something like this, where it probably won't even have this watch. It'll just look like this. It'll have a portfolio tab that would be empty because you don't have any positions. And there would be a pending tab. This means any pending orders. The first thing you can do is start to customize. So you can hit the little plus sign and start to create some folders to keep you organized. Now, let me say this before we get too far in. For our more advanced traders, they might find that they might say, well, I don't need all of this. So you might fast forward to the second half of the video. Our newer traders are going to be focused on what I'm talking about now and not worried about what I talk about later because it might go over their head initially. But that's where this recording can be reviewed in the future. So as we get into hedging your entire portfolio, hedging individual positions, you might not understand that yet, but this platform will show you a lot of the different tools and features and things that are available to you. One way to organize would be to create a bullish and bearish watch list. These are stocks that maybe fundamentally I'm bullish or bearish on, and you could give them any name you want, right? And we can drag those folders and move them over to different spots if we so choose. You could also organize by putting in different option strategies. Like you could say, these are my covered calls. These are my, maybe my bull put spreads and so forth. And you could just customize and create different folders here that are custom to what you're looking for. Within each of those folders, these are like watch lists, you can build various trades. So let's say we've done some fundamental homework and we like a few stocks. We'll put in a few different names here. So I'll put in a few stock symbols and it will give me a quote for those stocks. Now, here's a couple of important points. If these are the stocks that I like, I can organize them in different ways within this. So I could put all my energy stocks together, maybe my financial stocks together, my consumer stocks together. Notice you can just drag and move these anywhere you want, sort of like an Excel file program. And these stocks are going to be constantly updating throughout the day. Now, because this is a brokerage platform, it is operating, I believe, off of delayed data, which is fine. It's just a practice platform. When you're live in the markets, you'll have live data where you'll actually be able to see those prices moving in real time. Now, this paper trading platform What if I didn't know the stock symbol, but I knew the name? Well, I would simply click and maybe type in the whole name. Like, let's say I want to find Home Depot, but I don't know its stock symbol. So as I type in the name, it pulls up a list and it says, well, it could be this, this, or this. I can pretty much decide which one it is. Almost all of the stocks that I'm personally going to be interested in are going to trade either on the New York Stock Exchange or the NASDAQ. So I know, oh, HD is the symbol. That's the one. I punch in that stock and now I have that stock. So even if I don't know the symbol, I could put in the stock name and probably find it that way. If I didn't know what different ETFs or things, I could probably put in energy or something like that and have some different ideas for different things. Or I could even Google it and say, you know, what is an energy ETF? And it would find that XLE symbol. So anything related to the markets that way, be it individual stocks, ETFs, if I wanted to trade gold, I could trade the ETF that tracks gold prices through GLD and so forth. Again, this keeps you organized. Now, I want to do all of this under these folders. If I put in a watch list under my portfolio tab, it'll wipe it out. The only things that stay in your portfolio are actual positions. The only things that stay in your pending file are pending orders. So if I were to put out a pending order to try to sell this stock up here at 26 or something, and let's go ahead and transmit. Don't worry about what I'm doing just yet. I just wanted to show you that now that pending order will show up right there under that folder. It says any pending orders you have, here they are, and they will stay there. Now, if this was a good till canceled order, it would stay there day after day after day after day, right? If I do it as a day order only, then it will cancel away at the end of today. Now, maybe let's do an example order here of some option trade. So let's say, for example, I was interested in buying some silver, some SLV, and it's trading at 21.43. But in addition to that, I wanted to do it as a covered call. So I want to buy the stock and sell a call simultaneously. That is called a combination order. We're doing two things at once. Spread trading is doing two things at once. Butterflies, condors, you're doing multiple legs at once. So that's called a combination. Now, when you first pull up the stock symbol, you may not see that combinations button. You need to hit the little drop down and you'll see combinations right there. And now every time, if you select that once, every time you pull it up, it'll show you that option because it knows you like to do combination orders. From there, I go option combo smart. So type in the symbol, go to combinations, and then click on option combo smart. From here, we see a variety of different things, different options. We could do multiple legs where we point and click. We could do pair leg by leg where we build out the trade and we say we want to trade SLV and we just punch them in. I like to use the strategy. This is the tool I'll use most of the time because now I have a drop-down list of possible strategies. And a covered call is actually called a buy write. I'm buying the stock and writing a covered call at the same time. So anytime you hear the name covered call or buy write, it's the same thing. Notice it pre-builds the trade. Okay, you want to buy 100 shares and sell a covered call. Let's say we're going to sell the April 22 strike call. So I click OK on this, and this is not, again, SLV is probably going down. I don't know, I just randomly pulled something. But notice what's happened here. It's now built this trade as a combo. This line right here is literally a line that includes buying 100 shares of stock and selling the April 22 strike call. And if you look at the prices, you'll notice that's the case. If I buy the stock at 21.42 and sell this call and collect 40 cents, I'm paying about 21.02. And see how this price is a reflection of those two, buying this one and collecting this one. So this combo now is a covered call build. And I don't have to this shows up every day. So I don't have to rebuild, rebuild, rebuild. I could be waiting on this and saying, okay, let's wait until it gets to my price. Or I build this out and I say it's ready. I'm ready to go ahead and buy it. So maybe we're going to try to buy this at 21.02. Now let me show you a couple other features here. When you click to buy or sell, you can simply click down the bid or ask column. That's one way to do it. Here's another way. I could right click and choose buy or sell. Every time you do that, it might pull it up as a line, and sometimes that just trading from this line could be confusing. I like people to go ahead and, instead of trading from the line, double click on the line and it'll pull up an order ticket. And this way you can see it a little bit more clearly and you can work through it. So again, if it pulls up your orders on a line, just double click and it'll pull up the order ticket. Now notice that if I buy one of these combos, what am I doing? Well, it tells me the description up here. You're going to buy 100 shares of the stock and simultaneously, at the same time, sell one of the SLV April 22 strike calls. And you're going to pay $21.02 for this. We can further preview the order to see what's happening. If we're doing a debit trade, that means money's going out. Sometimes this will populate and show that you're collecting a credit. There are certain trades, if you build a condor or whatever, you'll see a C right here because you're collecting a credit. So make sure, this is before you ever transmit an order, you always preview the trade. And you double check your work and you say, okay, do I want to buy 100 shares? Yes. Do I want to sell one of the SLV April 22 calls? Yes. Do I want to pay $21.02 for that combination? Yes. That's $2,102. Okay, perfect. Everything looks pristine. I would transmit the order and away it goes. Now this is a practice trading account, but you'll notice that as I come over here to the pending file, now this order that I've sent out to the market shows up. Now this is, because it's a practice trading account, everything's on delayed data. So this thing does not, let me caution you that your paper trading, your demo account will be clunky. They just don't put a lot of money and technology into these practice accounts because they're just for practice. Okay, so look at how slow this is. It's not green. It hasn't even hit the market. If I was live in a live trading account, that would go within nanoseconds. It would be live to the market. Here, we've got some clunkiness to it. So you can see that there's something going on where it's kind of stalled out. Let's go ahead and well, let's wait for it. It should transmit. It should basically execute because I believe the stock is below that. Again, we're dealing with some delayed data. See that little pop-up? Delayed data is displayed within this paper trading account. But anyway, it'll get you some practice placing these orders. So again, that's one way to place the trade. You can type in the stock symbol that you want to trade. You can come to combinations, option combo smart. Now remember, part of this video is for our newer traders. Part of this video is for our more advanced traders. Now we need to explore some other things like some trading tools. There's a variety of different tools up here. If we hit the trading tool drop-down list, you can see we're not going to be able to get to all of it, but let's go into the option strategy lab. When I do that, it pulled it up on my other screen. Let me drag it over. This is kind of fun where you can do some scanning. And you can say, I want to edit the scanner and I want to look at target stock. And I want to forecast that between now and May, the price will rise by 5%. And I'm just putting in some random things and I click OK. And now what it does is it gives me a probability cone. Here's statistically where the stock is expected to be. Now remember, we're in the strategy lab. So based on the option prices, based on the standard deviations, here's how much it's expected to move between now and April, between now and May. Of course, the longer you give it, the wider the possible outcomes. I said that I thought the stock would move up 5% by May expiration, so it puts a target right there. It says By May expiration, 5% higher is at 167.20. If I change my scanner, I can edit and I can put in a different stock. Let's say we want to look at this stock. And we say we think that its price will drop by 10% by May expiration. So now we have this stock, we have its probability cone, and our target is down here 10% lower than current prices, and it shows us where that's at on the chart. Now, in addition to that, it will even give you some strategy ideas. It'll say, well, you could trade this bear call spread, or you could trade this bear put spread, or you could do different strategies that would take advantage of that drop in the stock. So it'll give you some ideas. It will also lay out, again, the probability, where this stock is expected to be and what the possible outcomes. So watch. If I say I'm interested in this particular trade, it will give me the risk graph for this, and it will show me that as the stock falls below 143, we're starting to see some profitability here. And then as it keeps falling and keeps falling and keeps falling, our profits rise until they're capped at the 127 strike. This is a bearish spread with max profit as the stock is at 127 per share or lower. The profit on this is up there at about $1,100. Our max risk on this particular trade is down here a little less than 500. It's about 455 max risk. And again, it's 1,100 and something max reward. So you can see the risk, the reward. You can see that risk graph in place right here. And here it shows you where your profitability is, basically. There's our target. Here's how this particular trade that we've selected would look on the risk graph from now to May expiration. So a lot of times we get questions, well, how do I pull up risk graphs and how do I pull up probability cones and some of the things that Thinkorswim has? Here's one place that you can do that. I can hit the edit scanner. Let's say I want to say Newmont Mining, and let's say that we think that this volatility is going to rise. Well, now it's a volatility play, and we say we didn't even put in a projection for the stock price. We just said we think it's going to get volatile. So here are some possible trades to take advantage of a big increase in volatility, such as trading a strangle. If I trade a strangle or some strategy like that, and let's see what it has selected here. We could put on a few different structures. In this particular trade, there's an inverse iron condor. So you could trade an inverse iron condor where you're expecting the stock to make a big move up or down, and that would create profit. And if it stays sideways, you would have a loss. So you can click through here and look at different structures and different strategies. Like if I bought this strangle, well, if it makes a big move up or down, I get into the profit zone. But if it stays sideways here, I got a big problem on my hands with this trade. Why would these trades make sense? Because I've told the scanner that I expect a big increase in volatility. And if you expect a big increase in volatility, there are some ways to take advantage of it. Next, let's go to maybe the option strategy lab. If I come in, whoops, we were just in the option strategy lab. Next, let's come into just the strategy builder. I skipped that one. So the strategy builder is kind of fun. Let's punch in a stock symbol. We were just looking at Newmont Mining, so what the heck? This is a gold miner. And the strategy builder, I'm going to make it a little smaller, and you'll see why in a second. From here, I can actually just go and point and click. So let's say I just wanted to zoom down here and look at the June options. And I wanted to maybe buy this one and sell this one. Now I've built a little spread right there. Buy the lower call, sell the higher call. If I hit the profile button, it's going to show me this on the risk graph. And it says, hey, if you buy that bull call spread, if the stock goes up, you're going to make money. See the risk graph? Here's the before expiration, the dotted line, and here's the at expiration. If the stock is at 55 or higher, we make our max gain. If the stock's at $50 per share or lower, we have our max loss. Here's our potential return, $335 of profit for $165 of risk. And it even tells me some details down here. Now watch, I can say, let's just see what happens between now and May expiration. So let's jump over to June, pardon me. It was a June 16th expiration. What happens on a 5% move? Well, on a 5% move in the stock, here's what our trade would look like. Loss, 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 little bit less loss, a small loss. So what this is showing is we need a bigger move. We're going to be at a loser at expiration if the stock's within a 5% range either way. So let's go to 10%. And now we start to see some profitability. And it says, hey, if the stock goes up 10% from its current price, we're now up 180 bucks. But if it only goes up 5%, we still have a little loss. Up 1%, small loss. You know, there's our risk that it doesn't move. What if it goes up 30? Well, now we're in business. Max gain up 20%. Max gain if it goes up 30%. So you can see by playing around with the percentage move how aggressive your trade is. And this tells a story. This says, boy, we need a pretty big move to be profitable. Because if it only goes up 5%, we're still not going to be profitable with this structure. We need a big upside move. If it stays flat, we lose. If it goes down, we lose. If it goes up a tiny bit, we still lose. So that is a very bullish trade. Now, does it make sense? Well, that's why our reward is much bigger than our risk, because our expected success rate is lower. Our probability is lower because we need a pretty big size move. Anything you construct in here, let's build a butterfly. Let's keep building here, and I'll just change this to 2. So now we've built a little butterfly, and look at the butterfly risk graph. And now we can see where we'd be at in various outcomes. So let's go back to the 5% move. Now if it stays flat, small loss up 1%, break even if it goes up 3%, profitable if it goes up 5%, that's immediately. If we go out to May expiration, or June expiration, pardon me, you're going to start to see some better numbers. Now as we go up 5%, we're actually in a little bit of profit, right? We still lose if it stays flat, but we have less risk, less of a loss because the trade costs less. And again, if it goes up 10%, we're starting to really make some money. If it goes up 12, 13%, it's hitting our max profitability. So it's still bullishly constructed, but a different risk graph. If we change it to 30%, now you can see the whole butterfly. And you can see that between 60 to 50 is where we would need it to be successful with that trade. So that will, again, show you risk graphs, allow you to click around and build, and that's called the strategy builder. You can go into the probability lab. He keeps pulling these over on my other screen. Here you could punch in any stock, and it would just give you a sense of where it's expected to trade between now and whatever date you put in. So this is a probability cone. If you said, where is Johnson & Johnson going to trade between now and June? Here's the expected range. And basically, we can figure out the one standard deviation, because the one standard deviation is 68%. And that's this area right here. So if you look at, if you basically take the 84% level, which is right in there, see that 83.29 in red, and you take the 16%, which is right over there, and you X those out, basically that side and that side are outside of the expected range. This stock is expected to be between the 140 to 170 level. Again, if I wanted to look at that on a chart, I could do that. Remember, that was between now and June. If I go back to the Option Strategy Lab and I type in Johnson & Johnson, it's going to give me that same probability range between now and whenever you choose. So let's choose June. And let's say we think it's going to do that. Well, now it shows me the expected trading range between now and June expiry. And it shows that it's expected that this stock at 153 could trade as high as up, let me make sure this is, let's build a little bit bigger price range. Let's go 25%. What the heck? So if we really build that out and I zoom in here, here's the June expiration. They've got this white dotted line. I don't know if you can see it. Our target's way the heck up there, but see where it's expected to trade between? About 166 on the upside and 138 on the downside. That's the expected range. That's the 68% probability range. So having a target up there probably doesn't make any sense. Why? Because the odds that it gets that far up there is just, it's a long shot. There's just no chance. So expecting a 25% jump, no, that doesn't make any sense. Okay, well, let's see if it could go up 10%. Even a 10% move, your target is outside of the expected standard deviation. Coming back to the probability lab, if we look at it, again, see how that 160-ish level? Targeting a move up here is a low probability bet. There's only a 2% chance or a 4% chance you get up into that zone. And there's only a 2% or 4% chance you get down here. Those are long shots. The probable outcome is that it's going to be, in fact, the most probable is that it's going to be between 155 to 160. The second most probable is that it'll be between 150 to 155. It's probable, third most probable is between 160 and 165. Fourth most probable, 145 to 150. Fifth and sixth most probable. And that right there is your range. That's the 68% probability area. So is it likely to be between 140 to 170? Yes, that's the most likely outcome. And you can see as you put in different dates, it will change the probability, right? If we go really short term, between now and Friday, it says, hey, this stock has a high probability of being between 150 to 155. I mean, very small price range because it only has 2 days or 3 days until that expiration. So it's just very likely to be within these few dollars, this little area right here. So you can change the date and that will change your probability accordingly. These are tools to help you with understanding all of these different metrics. So play around with those. Again, get comfortable with the software, build some different strategies, start to paper trade, use their demo trading account. Now, if I pull up a demo trading account like this, let me pull it up, you will see that it says this is a paper trading account for simulated trading. You can do anything you want here and you can't screw anything up. Let's go buy 100 shares of this at the market, whatever, okay? Go ahead, dismiss, okay? And it just executes. I can do anything I want, just play around with it. Here's something that might be kind of fun. As you build that, sometimes we get questions about hedging and understanding my entire portfolio. So let's do that from the Risk Navigator. Now, this is good for many of our international traders. They might not have access to Thinkorswim, but Interactive Brokers or some of these other brokerages do the same things. You have the same type of analysis available to you. So if I come into what they call the Risk Navigator, you can see that little button. I go into the Risk Navigator, it'll show whatever positions. Now this is just a demo account. It'll show what your unrealized profit is. This portfolio is up $1,000. It'll show the delta dollars. I'll come back to that. It'll even show you your beta weighted delta dollars. How much your portfolio is weighted in terms of beta, how that compares to the S&P 500 index, and so forth. So let's talk about this a little bit more fully. When you have a portfolio like this, and in fact, maybe the easiest way, I'm just going to quickly, maybe we'll close all of the positions. This is probably the best way to actually analyze this. Let me just close everything in here and we'll build from moment one. And the reason that this will work better, I'm just going to send market orders or whatever, and we'll just close these really quick. I want to take you through it piece by piece, and the reason is it'll make more sense as we do that, what all these numbers mean. If you have a lot of numbers, sometimes it's hard to follow the math behind it. If you have only one number, well, then it's very easy to see where that one number comes from. So if we close everything down at this point, the whole entire portfolio, now the whole portfolio is in cash. If we come into the Risk Navigator, of course, everything is zero, right? Every single thing is zero. Now, let's start to rebuild by just simply putting on small positions and see what that does to each one of those columns. This is kind of a good starting point. Now I'm going to start with the low price stock. Here is a stock that's at like $24 a share. Now watch what happens. That's $2,400 worth of stock. You can see right there. Let's go ahead and buy 100 shares. Now as I come into the Risk Navigator, what happens here? So we only have one position. Now notice how everything changed. We have unrealized P&L. It says we're down $4 at the start. Our delta dollars are 2,400. That just tells you about your position size and basically how much net delta you have. And this will make more sense in a second. So we have $2,400 of exposure. On a beta weighted adjusted basis, it's only 1,300, which means what? It means that this stock is so small, such a low price, that it's not a significant position compared to a higher price stock. Of course, our delta is 100 because we own 100 shares. Our weighted beta, 0.55. Half, remember the stock market average is a 1 beta, so 0.55, it basically tells you that this is kind of an insignificant position. It's not a huge position. It doesn't change a lot on a day-to-day basis. This $24 stock might go to $24.30. It might go to $23.70. It's just not moving a ton. Now this will make more sense when we add a high price stock. Let's pick one of these that's really, look, Berkshire Hathaway is a $300 stock. So watch this. I'm going to buy 100 shares of Berkshire. Now 100 shares of this is very different than 100 shares of that because they're very different position sizes. Now as I come in to my Risk Navigator, we just put $30,000 into Berkshire Hathaway. So what you're going to find is that Berkshire is now 30,000 in delta dollars. AU is 2,400. They're both 100 delta, but we know that this is where delta is kind of lacking. 100 delta of Berkshire is very different than 100 shares of AU in that they're very different position sizes. Now, here you can see your delta dollars are very high. Again, it's a lower beta stock, so it's only 23,000 on a beta weighted adjusted basis, meaning that if there was another stock that was at the same price at 305, it would probably be more volatile than Berkshire Hathaway. Berkshire Hathaway's volatility is very low. On an S&P comparison basis, this only compares to 7 S&P or 1,700 SPX, the index itself. So we can do some comparisons that way. Again, its weighted beta is 0.70. It's kind of a low beta, and that's why that number is lower than that number. Now watch. If we add something more volatile, let's go with something high priced and volatile like Tesla. I'm just going to buy 100 shares of that. Now it's a lower price point than Berkshire, but watch what happens to the beta on this one. Now we've added a third position. We've added Tesla. It's only $20,000 on a dollar cost basis. So it's delta dollars. It's a $20,000, well, $19,500 position size. But look at its beta, 1.75. Look at how it compares to the S&P, meaning Tesla's actually going to move your portfolio much more than Berkshire Hathaway, and Berkshire is going to move your portfolio much more than AU. And in fact, this is probably the most important column, which is to say how important is this position on a beta adjusted basis. And Tesla, even though it's $20,000 worth of stock, actually moves your portfolio as if it were 34,000. This is almost twice as volatile as a market average. If a market average is around 1 beta, this is almost twice that at 1.75. So which of these positions is most impactful? Well, it's Tesla. Now watch what happens if we add a short stock position. In fact, let's do this. Maybe instead of going long Tesla, we could short it. So I'm going to sell 200 shares, which will actually get us net short. We'll sell our 100, and now we'll get short 100. So now look at this. We're short 100 shares of Tesla, and we're long 100 of those other two. Look at how that changes your portfolio. So now, if we let's let this refresh, okay, and I'm gonna do it based on delta dollars on down, highest to lowest. Now we can see that Berkshire is 30,000 positive. It's a bullish position. We own the stock. AU is 2,400 positive. Tesla is now negative 19,000. But we're actually net. We have a bearish portfolio. Even though we own 33,000 and we're short 20,000, net, our beta, our delta dollars, we have a bearish portfolio. You can see it right there that on a beta weighted adjusted basis, we're actually net bearish in terms of our posture, in terms of our exposure here, because Tesla's movements create more risk and more reward than everything else, than these other two combined. And you can think of it like this. Basically what this says is that we're about $10,000 short the market on a beta weighted adjusted basis. You can think of it like volatility, meaning what would happen if the S&P moved this way or that way. So if the S&P moves up 2%, what might that do? Well, if we look at this beta, we can kind of say, well, this is, half of a beta. This is 3/4 of 1 beta. So this will make about 3/4 of that. This will make about half of that. So you can kind of say the S&P goes up 2%. Maybe AU goes up 1%, okay, at half a beta. It goes up 0.5% and then another 0.5%, so 1 total. This goes up 0.75 of 1, so maybe Berkshire is up 1.5% total on that move. But Tesla has a 1.75, so it's actually losing money if the market's pulling everything up. If the market's going up, we kind of make an assumption that it's pulling most things with it, right? So we'd assume this went up, but less than the market. We'd assume this went up, but less than the market because their betas are lower, we'd assume that Tesla went up, which is bad for us because we're short, but by how much did it go up? Well, it goes up 175% of what the S&P goes up. So when the S&P went up 1%, it went up 1.75, and then the S&P went up 1 more percent, it went up another 1.75. So it went up 1.75% times 2, basically. You know, it's going almost twice as much. So 1.75 times 2 puts us at 3.5. So Tesla is up 3.5%. Here's the problem. This is a profit, this is a profit, but this is a loss. If you think about where you're at net, you've made some here, but you have a bigger loss here. And that's what the portfolio is showing. It's showing that, hey, based on betas, based on volatility, if the market goes screaming higher, this Tesla is a bigger loss than those gain. Now, watch some of what happens here if you plot it out. So if we beta weight this portfolio, let's plot it. It should. So here's against the S&P. Why is that? Oh, I'd have to hit the update button. There you go. So if we just hit the update, now it's going to plot it versus the S&P 500. And what does the risk graph show in your portfolio? It literally shows that you have a bearish portfolio. See, you're profiting if the S&P goes down. You're losing if the S&P goes up. You see that? So we have a bearish posture. Now watch what happens if we change some things. So let's take Tesla down by half. Let's buy back half of the short position. And let's watch how some things change. So now if we come back into the risk navigator, what's happened? Well, we've taken our short position down. Our delta dollars were always positive, but it was kind of a misleading indication because our beta delta dollars were negative. Now they're back to positive. Now we have a net bullish portfolio because these two are now more impactful than this one short position. So notice how your risk graph has flip-flopped. How you profit if the market goes up and how you lose if the market goes down. Now we are net bullish. If you're not seeing these columns here, then what you need to do in order to see them is come into the metrics, and you can go into beta and make sure that you have the beta column, the SPX index, delta, the delta dollars, whatever you want to choose, but those are the ones that we're describing here, your weighted beta. And you can also come into view, and under the view file you just hit beta weighted portfolio. So that will give you, that's what this right here is, your weighted beta. But this again is very instructive. What if I wanted to hedge this portfolio and get net neutral? If I wanted my portfolio neutral, essentially based on the beta, I could go short 7,000 of SPY. If I went and shorted $7,000 worth of SPY, then I would be essentially taking my net exposure down, my beta. Now that might not be perfectly, you could short 23,000 to get your delta dollars at 0, but that would skew you very bearish on the beta. In fact, let me show you that. If we just shorted $23,000 worth of SPY, this would go deeply negative. So what's 23,000 of SPY? 23,000, let's go here. 23,000 divided by its 404-ish price would be about 56 shares. So watch, this will take our dollar amount to 0. but it's going to skew our beta, which is really how our portfolio moves, very much. So see how our delta dollars basically went to zero? We have a perfectly neutral portfolio in terms of total amount. We have about 32,000 or so in short positions and about 32,000 in long positions. So our delta dollars are at zero, but that's a little misleading because again, Tesla's highly impactful. These are low beta. And so actually, again, we're back to a very bearish portfolio. And if you wanted to be more neutral, truly neutral, it needs to be this column. You would have to say, let's go close most of our short and just leave on a few shares. We can kind of guesstimate at it. Let's just close 40 of those and leave 16 of the shares. And that might still be a little too high. But basically, okay, there we're pretty close. So you see how we now are pretty darn close to zero on the beta weighted adjusted basis. We still have more stock in long positions than short, but these are higher beta. They're more impactful. See how the S&P is at a 1 beta? So remember how I said that if you wanted to get perfectly delta neutral, you were going to have to short about 7,000. Well, we only shorted 6,400. That's why we have just a slight number there. So as you play around with this, it makes more and more sense. And notice how our portfolio is now basically neutral. Now, as you add option positions, of course, that's going to skew things. And somebody might say, well, why would you ever want your portfolio neutral? You don't normally want it neutral. We always, for the most part, we try to keep a bullish exposure because I always emphasize the stock market long term kind of works like this. It's always moving to higher prices long term. It's just that you could spend a couple of years going down in a bear market, right? But it's always kind of on that trajectory. So there are times where we want to take less risk or kind of neutralize the portfolio or do some things. But for the most part, we do try to keep that positive because we believe that markets are going to go up. If you were really bearish, well, you could skew it bearish for a period of time when the opportunity arises. Adding options to the mix is going to change your portfolio mix accordingly. So if we come in here and let's just add some bearish trades, whatever, we can probably buy puts on some things that are a little higher priced or whatever. So let's just buy some puts on this. I'm just randomly kind of selecting stuff. And again, you would never send market orders in live trading, but when you're just screwing around, you just send market orders so they go through quickly. If you're demo trading like this in a paper trading account, have at it. You can see that these are not live streaming numbers. We are working on delayed data as well. And for some reason, I'm not getting any quotes on these. I have no idea why. But let's go ahead and buy one. Let's buy 3 at the market or whatever. I'm just going to show you. Okay, they're going through even though we've got question marks. Let's buy 2 of these or something. So I don't know why there's question marks on the quotes, but whatever. Okay, so these are going through, and now you can see that we just bought some Garmin puts, we bought some Home Depot puts, whatever, and you can see the total dollar amount. That's $1,600 worth, that's $4,200 worth. Now this is going to change our portfolio makeup. Well, if you look at this, of course, our beta dollars, we're very, very bearish at this point. You'll see that those puts would be impactful even if you close some of the others. So Tesla, we know that 50 share short is a big impact. Well, watch. If I close it and mess around with this, now it takes our delta dollars down. Let's do one more. Let's close the SPY short. So we're going to close out the short stock positions and just leave those puts. And it might still be bearish. But this gives you a little smile. See the little smile effect. And what's basically happening here is, it says, hey, these are very bearish positions. This Home Depot position is as if you were short $35,000 worth of stock. That's the impact it has. It's a high beta. This one has $14,000 worth of bearish exposure just buying those puts. Now, the reason that this goes up as the market goes down is because those puts are going to explode in value and make you a lot of money. You can see that if the market went up a ton, so if the market goes up 5%, we're negative. If it goes up 10%, 15%, we're negative. We're losing money. But if it explodes higher here, why do we go back to profitability? How are we making money up here or down here? Well, the reason is that these puts would eventually lose all of their value if the market went up enough. So if the market goes up a ton, you'd lose everything in those puts, but these would make enough to get you back to profitability, right? And you could look at it the other way. If you had stock and you have bought protective puts or something like that, and then you had some short stock, it would go up here, and then it would dip this side, and then it would go up over here. Why? Because your long stock would make money immediately if we go up. If we go down, your puts are protecting it. So eventually you stop losing on these, and now your short stock positions start making money. So you can have all sorts of curvatures depending on what you have in your portfolio. In this case, we're very bearish. We're built bearishly the way it looks. If the market goes down 5, goes down 10, goes down 15, you see we're making more and more money. If it goes up, we're losing money. That's the way it's constructed, right? And so getting familiar with all of these ins and outs is important. Now, I own puts in Home Depot. What if I wanted to hedge just that position? Okay, I own, well, it doesn't tell me the positioning exactly, but I know that I bought 2 or 3 puts. I don't remember which one. But watch this. If I click the hedge button right here, and I just click that I want to hedge, I've selected which one I want to hedge, and I hit there. It says, well, this action will create a hedge in your sub-portfolio. It's going to do it for you. If we own puts here, what do you think the hedge is going to be to that trade? Well, I can make an educated guess. It's going to put buying stock as the potential hedge. Why? Because my puts make money if stocks go down. To hedge that, I would need something that makes money if stocks go up. And so it's going to have us buying stock if we want to hedge the puts. If we want to neutralize the puts, we got to buy stock. And I'll also make an educated guess that it's going to put in 131 shares because the Home Depot trade has negative 131 delta. So what do you want to bet that it's going to say, well, to hedge this, you could buy 131 shares. Watch this. So let's click yes to continue. We come in to the portfolio and look at what it put in here. It put in an automatic buy order for 130.83. I'm just going to round that to 131, which was our guess. I guess I got that wrong because I said it'll put 131 shares, and it actually put 130.84679 to whatever. But you see how it put in buy 131 shares? Because that's the hedge. Okay? Now watch. If I buy 131 shares, now in my portfolio, I own the puts, 2 of them, and I own 131 shares. If we come back and look at that position, Home Depot is now delta neutral, and by buying that stock, I have skewed my portfolio back to bullish. Now I make money as the market goes up. I lose if it goes down, but if it goes down a lot, I go back to profitability. Again, this is hedged. So if we go down and then back up, these puts start making money, more than these lose, and this one's hedged. let's add another hedge. We bought puts in Garmin. So I'm going to say we want to hedge it. I'm going to make a very educated guess that says it's going to tell us to buy 144 shares of Garmin if we want to completely neutralize that position. Now, granted, it's probably going to be 143.975, whatever, but it's going to put around 144 shares. Watch this. Okay, I hit the hedge. I hit the hedge. I could not have this pop up. I could just say, remember my decision from now on. But this is good that it shows you where it's going. So I click OK. Now I come over to the sub portfolio. There's Garmin. There's your buy of 144 shares. Again, I wouldn't do the point. You can buy fractional shares nowadays, but I would just buy 144. Let's go ahead and buy 144 shares. Now our portfolio is going to be very bullish. And Garmin is now delta neutral. Garmin has now skewed our portfolio even further. We're $24,000 beta weighted bullish. We're $33,000 worth of stock long, but we're actually 24,000 is what our exposure is. If we wanted our portfolio to be delta neutral, what would you do? You'd go short $24,000 worth of SPY. And then we would have literally our portfolio on ice. It would not really move. It would be flat. But you can see that, again, we're bullish. We're even more bullish now because see how it doesn't really turn back to profitable on this side unless we go down an enormous sum. Basically, you're going to lose if we go down. You're going to make money if we go up. That's how the portfolio compares to the S&P 500. Watch what happens lastly if we short 24,000 shares of the SPY. Let's do it. What is 24,000 shares? 403. Let's do it together. 24,000 divided by 403 is 59.55. Let's just short 60 shares. We'll round up. That should take our beta adjusted portfolio exposure down to 0, and it basically did that. And now look at our portfolio. It's just sort of on ice. As we move in the immediate term, we're not really making or losing anything for the next couple of percent. Now this portfolio, you know, it kind of almost shows a perfect scenario where you can make a lot of money or you can make a lot of money. There's like no loss potential. The reason that's probably not true is right over here. We're losing from theta, and we're losing a decent amount per day because the only option positions we have on are theta negative. They're losing from time decay. If you look at it right here, we bought puts in Home Depot. We bought puts in Garmin. Both of those are time decay positions against us. So if we come over to our portfolio, we don't have anything making money. These are our only two option positions. They're the only ones with some theta. In both cases, we bought options, so we are theta negative. We're losing from time decay. And so it may not be as perfect as this graph kind of shows where you can't lose because there is time decay here. And if the market kind of stays in flat and in this area, this line will just keep kind of bleeding lower, bleeding lower, bleeding lower, bleeding lower, and kind of just decay in that manner, basically. So there is some risk. There's always potentially some risk somewhere, and right now we've got a little theta bleed risk. But on a beta weighted adjusted basis, you can see that we've pretty much put our portfolio on ice. We don't really have any risk, any reward, anything for the next couple of percent. As it moves, we're just right here at about 0. Nothing gained, nothing lost. So that's a good detailed description of the Risk Navigator and the ins and outs of it. And as you play around with it, it'll just make more and more sense, no doubt. We'll leave it there. Thanks everyone for joining us. These weekly coaching forums are just so much fun. We're able to explore new topics every single week in the coaching program, go through things like this, go through different strategies, checklists, scans. There's just so much great information that we can share, and we always try to pack in as much information as possible each and every week. So thanks for being a part of the coaching program. You're what makes it great, and we will see you next week. Same time, same place. Goodbye, everyone.